Most traders don't lose because they don't know where to enter or exit. They lose because they are trading the wrong time frame for their mind. One trader opens a 1-minute chart and feels powerful for 5 minutes, then panics. Another opens a daily chart and feels bored, then forces a trade. Same market, same strategy, completely different results. The truth is uncomfortable but simple. The market is not against you, your time frame is. There is no single best time frame for trading. There is only the best time frame for you. That line alone, if you really understand it, will save you years of frustration. Most traders lose not because their strategy is bad, but because they are fighting a time frame that does not match who they are. Your psychology, patience level, lifestyle, and decision-making speed matter more than any chart setting. Let's break this down cleanly and honestly. Lower time frames like 1-minute, 3-minute, or 5-minute charts feel exciting. Price moves fast, opportunities seem endless, you feel busy, active, involved, but here's the hidden cost: noise, constant signals, emotional overload. You are forced to make decisions before your mind has time to settle. If your discipline is not rock solid, these time frames will expose every weakness you have. Overtrading, revenge trades, FOMO, stress. Low time frames are not bad. They are just unforgiving. They demand extreme focus, fast execution, and emotional neutrality. Most traders think they want speed, but their psychology cannot keep up with it. Mid-time frames like 15-minute, 30-minute, and 1-hour charts are where many traders finally breathe. Price structure becomes clearer. You get fewer but higher quality setups. You have time to think, not react. Mistakes still happen, but they are slower, easier to catch, easier to correct. This is where many profitable traders are born. Not because the market is easier, but because the trader finally has space to follow rules. Higher time frames like 4-hour daily and weekly charts are calm, almost boring. And that boredom is power. Less noise, stronger levels, bigger context. Your job shifts from prediction to patience. You wait, you plan, you execute only when the market clearly invites you in. The biggest myth in trading is that higher time frames mean slower money. In reality, they often mean cleaner money, fewer trades, fewer mistakes, more consistency. Now here is the most important rule most people ignore. Your entry time frame should be lower than your bias time frame. This means you decide direction on a higher time frame, then execute on a lower one. For example, bias on the 4-hour daily chart, entry on the 15-minute or 5-minute. This alignment keeps you trading with structure, not emotion. If you enter on the same time frame you analyze, you will always feel late or uncertain. If you enter lower without higher context, you will feel lost. Professional traders don't ask, what's the best time frame? They ask, what time frame keeps me disciplined? If you are emotional, impatient, or revenge trading, go higher. If you are bored, overthinking, or forcing trades, go higher. If you are missing entries but calm and consistent, then maybe go slightly lower. The market doesn't need you to be fast, it needs you to be aligned. Choose the time frame that allows you to follow your rules when money is on the line. That is the only time frame that matters. Most traders believe the market is the hard part. They believe price is unpredictable, manipulation is everywhere, and institutions are hunting their stop losses. But the real battlefield has nothing to do with the chart. It's inside the trader. And the time frame you choose decides how intense that battle becomes. When a trader opens a chart, they think they're choosing candles. What they're really choosing is pressure, speed, emotional exposure. A 1-minute chart is not just faster price. It is faster fear, faster hope, faster regret. Every candle demands attention. Every tick feels like judgment. The market does not wait for your certainty. It forces you to act before you are ready. That's why time frame selection is not technical. It's psychological. A trader with weak emotional control who trades low time frames is not unlucky. They are mismatched. They are putting themselves in an environment where their flaws are amplified. The market isn't punishing them. It's reflecting them. Think about this. On a low time frame, you can be right and still feel wrong. Price moves against you slightly and your confidence collapses. You close early. Then price goes in your direction and now frustration replaces fear. That emotional whiplash has nothing to do with strategy. It has everything to do with speed. Speed removes thinking space. Most traders do not fail because they lack knowledge. They fail because they cannot stay calm while uncertainty unfolds. The lower the time frame, the less time the mind has to process uncertainty, and an untrained mind fills that gap with emotion. Now compare that to a higher time frame. A 4-hour daily chart does not scream at you. It speaks slowly. It allows ambiguity to exist without demanding immediate action. Pullbacks do not feel like threats, they feel like structure. Losses do not feel personal, they feel statistical. This is why many traders who move to higher time frames suddenly feel like the market became easier. It didn't, they became calmer. Your psychology determines how much information you can handle without reacting. The time frame determines how much information is thrown at you. When those two are misaligned, discipline collapses. A common mistake traders make is choosing a time frame based on money goals instead of emotional capacity. They want fast profits, so they choose fast charts. But fast charts do not give fast money to undisciplined minds. They give fast mistakes. The market does not reward urgency. It rewards clarity. Every trader has a natural decision-making speed. Some think fast but shallow. Some think slow but deep. Neither is wrong. But forcing yourself into a time frame that conflicts with your nature creates internal conflict, and internal conflict always leaks into execution. This is why copying another trader's time frame rarely works. You are not copying their psychology. You are copying their tools without their temperament. A professional trader understands this. They don't ask, where can I make the most trades? They ask, where can I stay consistent? Consistency is not about winning more. It's about reacting less. If your heart rate spikes every time price moves 10 pips, your time frame is too low. If you feel bored and start forcing trades, your time frame may still be too low or your plan lacks structure. Boredom is not a signal to trade. It's a signal to wait or to move higher. The market is not entertainment. It is an environment of risk, and every environment demands a matching level of psychological fitness. Low time frames demand emotional mastery. Higher time frames demand patience and trust. Neither is superior, but one will fit you better than the other. The moment a trader stops asking what time frame makes money and starts asking what time frame protects discipline, their results begin to change. Because discipline is not something you force, it is something you design for. Your time frame is part of that design. Choose a time frame that slows your thinking just enough to keep you rational, one that allows losses without panic, one that allows wins without euphoria, one that lets probability work without interference. The market will always be uncertain, but your reactions don't have to be. When your time frame matches your psychology, the market stops feeling like a threat and starts feeling like a process. And that is where real trading begins. Every trader remembers the moment they first realized the market is loud. Not loud in sound, but loud in signals. Arrows, indicators, candles, wicks, news, opinions. Everything is screaming for attention, and nowhere is that noise more aggressive than on lower time frames. On a 1-minute or 5-minute chart, price never rests. Candles form and close before your mind finishes processing the last one. You feel like if you blink, you will miss something important. That feeling creates urgency. And urgency is one of the most dangerous emotional states a trader can operate from. Noise is not randomness. Noise access information without hierarchy. On lower time frames, everything looks important because everything moves. Small retracements look like reversals. Normal pullbacks look like failures. Sideways consolidation looks like manipulation. The trader is not reading structure. They are reacting to motion. This is where most traders confuse activity with opportunity. The market does not reward activity. It rewards alignment. Noise tricks the brain into believing it must act. The mind is wired to respond to movement. Evolution trained us to react quickly to changes in our environment. In trading, that instinct works against us. The faster the chart, the more primitive the response. Fear shows up faster. Hope shows up faster. Regret shows up faster. And when emotions accelerate, logic falls behind. A trader on low time frames is often technically correct but emotionally overwhelmed. They see the setup, they know the rules. But they cannot sit through the normal fluctuations required for the trade to work. So they interfere. They exit early. They re-enter late. They change targets. They move stops. Not because the market told them to, but because the noise pressured them to. Now compare that to higher time frames. When you move up to a 1-hour, 4-hour daily chart, something strange happens. The market starts making sense. Levels become obvious. Trends stop looking chaotic. You can see where buyers stepped in before. You can see where sellers lost control. You are no longer inside the storm. You are watching it from above. This is not because the market changed. It's because the noise dropped out. Higher time frames compress information. They filter out emotional reactions and show only what matters. Price closes, not flickers. Structure forms, not impulses. You are no longer reacting to every tick. You are responding to completed decisions. This is why higher time frames feel boring to many traders. And boredom is misunderstood. Boredom is silence after chaos. Traders who are addicted to low time frames often mistake boredom for danger. They think if nothing is happening, something is wrong, so they force trades, they zoom in, they hunt entries, they manufacture excitement. But boredom is where discipline lives. Professional traders are not entertained by the market. They are detached from it. They do not need constant stimulation. They need clarity. And clarity comes when noise is reduced. Noise reduction does not mean fewer opportunities. It means fewer false opportunities. Most losing trades do not come from bad analysis. They come from reacting to information that never mattered in the first place. Higher time frames answer a critical psychological question: what actually matters? When price breaks a level on a 1-minute chart, it feels significant. When price breaks a level on a daily chart, it is significant. The difference is not price movement, it is participation. Institutions do not operate on noise, they operate on structure. Retail traders often believe institutions hunt stops on low time frames. In reality, institutions don't care about your 5-minute chart. They care about liquidity zones formed over hours and days. They care about areas where real volume accumulates. When you trade higher time frames, you align with meaningful decisions, not emotional reactions. Another powerful effect of higher time frames is emotional spacing. Spacing gives your mind room to accept uncertainty. On low time frames, losses feel personal because they happen fast. On higher time frames, losses feel expected because you had time to plan for them. Planning changes perception. When a loss is anticipated, it does not shock the nervous system. This is critical. Shock creates revenge. Planning creates acceptance. Most traders revenge trade because they are surprised by losses. And they are surprised because noise hid the bigger picture. Higher time frames remove surprise. Now here is an important truth many traders resist. You do not need more trades to make more money. You need fewer mistakes. Noise creates mistakes. Every unnecessary decision increases error probability. Every extra trade introduces emotional risk. Higher time frames reduce decision frequency, and in doing so, they protect capital. Capital protection is psychological before it is financial. A calm trader risks better. A calm trader exits better. A calm trader waits better. Higher time frames promote calm by design. This does not mean low time frames are wrong. It means they are advanced environments. They require emotional neutrality, rule mastery, and self-awareness. Most traders use them too early. You don't learn discipline on noisy charts. You prove discipline there. Discipline is built in silence. When traders move to higher time frames and see improvement, they often think they found the holy grail. What they actually found was a reduction in internal conflict. Less noise means fewer emotional triggers. Fewer triggers mean better execution. Execution, not analysis, is what separates winners from losers. The market will always move, but you don't have to move with it. As noise shrinks, patience grows. As patience grows, clarity forms. As clarity forms, consistency becomes possible. That is the real power of higher time frames. They don't predict better, they pressure you less. And trading is not about prediction, it is about decision making under uncertainty. Reduce the noise and you reduce the emotional cost of uncertainty. That is how traders survive long enough to succeed. Bias first, entry second. One of the biggest reasons traders feel confused in the market is not lack of knowledge, it's lack of separation. They mix analysis and execution into the same moment, on the same chart under the same emotional pressure. When thinking and acting happen together, emotions always win. Professional traders separate these two roles very deliberately. They decide what side of the market they want to be on first. Only later do they decide where to enter. This separation changes everything. Bias is not a prediction. Bias is a framework. It is your understanding of where the market is more likely to move based on structure, context, and probability. Entry is simply timing. Most traders reverse this order. They look for an entry first, then try to justify a bias. That is backwards. When you search for entries without a higher time frame bias, you are trading randomness. Every setup looks valid. Every candle looks tempting. You are not aligned with direction. You are gambling on movement. This is why traders often say the setup was perfect, but it failed. The setup wasn't the problem. The context was missing. Bias must come from a higher time frame because higher time frames contain intention. Lower time frames contain reaction. A 5-minute chart shows you how price reacts. A 4-hour chart shows you why. Without understanding the why, execution becomes emotional. Think about what happens when bias and entry live on the same chart. You see a candle form, you feel pressure, you hesitate, you enter late. Price pulls back, you panic, you exit. Then price moves exactly where you originally expected. This cycle destroys confidence. Not because the trader is wrong, but because they are mentally overloaded. Higher time frames remove urgency from decision making. You are not trying to decide direction while price is moving rapidly. Direction is already decided. The only question left is timing. This is powerful. When bias is set in advance, lower time frame noise loses its power over you. Pullbacks no longer feel threatening. They feel like opportunities. Consolidation no longer feels confusing, it feels like preparation. Your emotional response changes because your cognitive load is reduced. A trader without bias asks, what is the market doing right now? A trader with bias asks, is the market giving me permission to enter? Permission is patience. This is also where trust begins to form. Trust does not come from winning trades. It comes from following a process that makes sense regardless of outcome. When bias and entry are separated, losses no longer feel like failure. They feel like execution of probability. Losses only hurt when they feel random. Alignment removes randomness. Another critical psychological benefit of bias first trading is reduced self-doubt. When you enter without higher context, every opposing candle challenges your confidence. When bias is clear, opposing candles are expected. You already accepted their existence before you entered the trade. Acceptance is emotional armor. Most traders are not afraid of losing money. They are afraid of being wrong. Bias helps redefine wrong. A loss does not mean you misread the market. It means probability expressed itself differently this time. This mindset shift is subtle but transformational. Professionals do not need certainty to act, they need clarity. Bias provides clarity. Entry provides execution. Mix them together and clarity disappears. This is why higher time frame bias with lower time frame execution is so effective. The higher chart calms the mind. The lower chart sharpens the action. One provides stability. The other provides precision. Without stability, precision becomes stress. Many traders think they are impatient by nature. In reality, they are impatient because they are constantly deciding direction in real time. That is exhausting. When bias is pre-decided, patience becomes natural. You are no longer hunting trades. You are waiting for confirmation. Waiting is not passive. It is active discipline. The market does not reward people who act first. It rewards people who act with alignment. Bias aligns you with structure. Entry aligns you with timing. Together, they align you with probability. And probability is the only edge that matters. When traders finally understand this, their behavior changes. They trade less. They interfere less. They stop chasing. They stop forcing. Not because they are trying harder, but because the system is doing the emotional work for them. Trading becomes simpler, not easier, simpler. And simplicity is what allows consistency to emerge. Because consistency does not come from brilliance, it comes from repetition without emotional damage. Bias first, entry second. That order is not optional, it is foundational. The best time frame is the one you can obey. Every trader says they want consistency. Very few traders design their trading around obedience. And that is the real problem. The market does not pay you for intelligence. It does not reward effort. It does not care how badly you want it. The market rewards one thing only: disciplined execution over time. And discipline is not a personality trait, it is an environmental outcome. You do not become disciplined by force. You become disciplined by placing yourself in conditions where discipline is the easiest option. This is why the best time frame is not the fastest, the slowest, or the most popular. It is the one you can follow without negotiating with yourself. Most traders break rules not because they are reckless, but because their environment pressures them to. A time frame that constantly triggers fear, urgency, or boredom will slowly erode even the strongest intentions. Eventually, the trader bends the rules just to feel relief. That relief is temporary, the damage is permanent. When traders say, "I know the rules, but I still break them," what they are really saying is, "My time frame is stronger than my discipline." Obedience is about alignment between rules and emotional capacity. If your rules require patience but your chart demands constant attention, conflict is inevitable. If your rules require selectivity but your chart offers endless signals, discipline collapses under temptation. The market will always offer more opportunities than you should take. The right time frame filters those opportunities automatically. This is where many traders misunderstand willpower. Willpower is a finite resource. You cannot rely on it during uncertainty, stress, and risk. The moment money is on the line, willpower fades. Design must take over. The right time frame removes the need for willpower. It slows decisions enough that logic can intervene. It spaces outcomes enough that emotions can settle. It limits signals enough that selectivity becomes natural. This is not about comfort. It is about sustainability. A trader who survives emotionally survives financially. The reason many traders bounce from strategy to strategy is not because the strategies fail. It is because the trader cannot obey them consistently under pressure. They search for a system that removes emotion, but emotion is not removed by indicators. It is managed by structure. Time frame is structure. When a trader finds a time frame they can obey, several things change without effort. They stop overtrading. They stop revenge trading. They stop micromanaging positions. They accept losses faster. They let winners develop naturally. These changes feel like maturity, but they are actually alignment. Aligned traders do not need motivation. They need repetition. Another overlooked truth is that obedience creates confidence. Confidence does not come from winning streaks. It comes from knowing you will follow your rules regardless of outcome. That trust in yourself is far more powerful than trust in analysis. A trader who trusts themselves can handle drawdowns. A trader who does not will self-sabotage. Time frame choice determines self-trust. If you constantly break rules on a certain chart, the chart is not exposing weakness. It is demanding more than you can give right now. That is not failure, that is information. Professional traders listen to that information. They adjust the environment, not their self-worth. This is why moving to a higher time frame often feels like relief. It is not because the trader became better overnight. It is because the environment stopped attacking their nervous system. Calm traders make better decisions. Better decisions compound. The market is already uncertain. You do not need to add internal chaos. The goal of trading is not excitement. It is execution, not prediction. Process, not action, obedience. When your time frame supports your ability to obey, trading stops feeling like a fight. It starts feeling like a routine. And routines, when repeated long enough, create consistency. Consistency creates longevity. Longevity creates edge. That is how professionals are built. Not by finding the perfect setup, but by finding the time frame they can respect when emotions are loud and outcomes are unknown. If you can obey your rules on a chart, that chart is right for you. If you cannot, it does not matter how profitable it looks on paper. The market does not care what you intend to do. It only reflects what you actually do. Choose the time frame that lets you do the right thing even when it's uncomfortable. That is the real edge.